Welcome, everybody, to the Real Estate Show. We have rebranded, and I just thought that the Real Estate Show is a lot easier to remember and to search when you're looking for, all that real estate information that you want so that you can make an educated decision this year and all of the years to follow. So I'm here with Karlee Moore. She is a mortgage specialist. Super excited to be having a conversation today about the mortgage world and the real estate world and maybe what we can expect to happen. Obviously, we do not have a crystal ball to be able to tell you all the details of what's going to happen in 2025, but we can definitely have a conversation about what we think is going to happen and give you some tips and tricks on how to prepare yourself for a successful purchase, a successful sale, and maybe some tips in between of things that you can start doing now to make that educated decision. So welcome, Karlee. Super excited to have you today.
Thanks for having me back, Michelle. Excited to be here.
Yeah. So we just had an announcement from the Bank of Canada back in December. It was another rate cut. How did you feel about that?
Yeah, it's great. I mean, in one way, it's great. It's great for borrowers. Obviously, when the Bank of Canada is making these decisions and they're decreasing that rate, they're trying to stimulate the economy. So it's not always great news for the economy, but it's good news for us as consumers. And so that rate decrease that they just did brought the overnight lending rate down to 3.25%, which is nice. It's putting the variable rates, because for those who aren't familiar with what the Bank of Canada does, they meet 8 times per year where they're going to assess the overnight lending rate. And that rate directly impacts variable rate mortgage holders and things like lines of credit, things that are variable rates. And so with the decrease, it decreases variable rates specifically. There's oftentimes an indirect effect on fixed rates, but fixed rates are governed by sort of a different thing. But so variable rates now are back into a comparable area with fixed rates, which is nice. And we are expecting the bank to come down a little bit further. So the most recent, as I mentioned, the most recent drop brought that overnight lending rate to 3.25%, which is just in the neutral zone. It's at the higher end of the neutral zone. And so it is possible we'll see the bank come down to 2.75, maybe a little bit lower, 2.5. So that probably won't happen right away. It might be over the next year, but if everything kind of goes as it has been, we should see that rate come down a little bit more, which then is going to impact variable rate holders and make things just a little bit more affordable for everyone, which is key.
Yeah. And I think too that one of the biggest misconceptions with these Bank of Canada announcements is the fact that it does only affect the variable rate. It does not affect the fixed rates. But like you said, it does have an indirect effect on obviously what banks decide to do with those fixed rates. But yeah, I think a lot of times people are like, oh, sweet, like it's so good that the rates went down. But I think from my perspective, like when I'm working with buyers, most of them, I will say, go for the fixed option as opposed to the variable option. What do you see when you're working with your buyers?
I see mostly fixed or higher percentage fixed, but I do get quite a few people interested in the variable. And it's also a product that I believe quite fully in. So it's something that I recommend to my clients quite heavily if I think that they are able to handle the risk associated with the variable rate, because yes, variable rates can go down, but as we know over the last few years, they can also go back up. And so if you cannot absorb additional mortgage payments or a higher interest rate, then it's not the right product for you. Or if you're going to be stressed about whether your rate's going to go up or down and how that's going to impact your payment, then obviously not the right product for you. But in my portfolio, it's a little heavier on the fixed rate side, but a good chunk of my clients are in the variable rate as well. I'm a big fan of it. It comes with a smaller penalty traditionally, or at least a guarantee of a lower penalty compared to fixed rates. And statistically, most people will break their mortgage if you're in a 5-year and in the third year or higher. And so that's a lot of penalty to pay for when you could try to get it as small as possible, that penalty. So I'm a big fan of the variable rate. I think it's a really, really good product. More people are interested in it right now. I'm finding, obviously, I think a lot of it has to do with media coverage. And you're right, Michelle, when you had mentioned a lot of people think that when the Bank of Canada decreases that overnight lending rate, that means that all interest rates are going down. Yep. Not necessarily the case, but it does kind of think interest rates kind of do move together somewhat. But when that's in the media, then people are like, oh, I should go variable because it's going down. So
exactly.
Yeah, but good product. I'm a big fan of it.
Yeah, I think too, if you were to actually take into consideration, and I'm sure you can look at, obviously you can look at that after the fact, but when you look at like the penalty that you pay with your fixed rates, as opposed to the fluctuations in your payments over those 3 years or whatever, it may actually be a better option to have opted for the variable because of how heavy that penalty is. Because I know that I've broken, I think, 2 fixed rate mortgages, and it's been in the tens of thousands to break.
Yeah.
And so I don't know if we would have seen tens of thousands of dollars worth of fluctuations in payments in those, say, 3 years or whatever, but it's definitely a key element to being educated on, because what everybody thinks or has a notion of may not actually be like the education that you truly need to be able to make that decision that is best for you.
You're right. And it comes down to selecting the proper term as well, right? With mortgages, you can take a 1 year, a 5 year, a 3 year. And especially if you're going on the fixed rate side, it's really important to pick the correct term. If you know you're going to be moving in 3 years, well, then don't take a 5-year fixed, because that penalty is going to be quite large when you choose to pay that out. Whereas, you're only saving maybe 0.2%. So on your interest rate by taking the 5 year. So yeah, there's a lot of strategy involved. And obviously we don't always know what we're going to be doing in 5 years. So giving yourself the most amount of flexibility, I think, is really, really important. And that's one of the things I just share with my clients, is making sure that if they have a plan, they know what they're doing. Well, let's structure the mortgage specific to that plan. If they don't, let's give them the most amount of flexibility so that if there are changes that come up in your life, they're going to be able to kind of handle that and not get hit with a big penalty.
Yeah, because you never know what with life, right? You never know what could happen. And, and a lot of times in those situations where it's an unpredicted situation and there's usually stress involved, maybe adding more stress to having to pay out a big chunk for a penalty just doesn't add anything positive, I guess, to the situation. So
yeah, exactly.
And so in 2025, statistics tell us that there is 1.2 million Canadians that have a mortgage to renew this year, myself included. And I know that most people who do have mortgage renewals this year, or I shouldn't say I do know, my situation is my mortgage is locked in at 1.84%. And so obviously rates are not at that point right now, but by the end of the year, maybe they will be closer to that. So people who have held on from 2020 to now, instead of having to have broken in the last couple of years, hopefully is in an okay position. But we probably will see, some situations where mortgage payments are going to be significantly higher than what they're used to. So what do you think that's, what kind of impact that is going to have on our market this year?
Yeah, it should be pretty interesting to see. And when your renewal comes up, it's a good time to really reassess and reevaluate your current financial picture, what your goals are, because at renewal, you can change lenders, you can change products, you can push out your amortization. There's all sorts of things you can do without incurring any sort of penalty. So it's a really great, refreshing time to just take a big look at the big picture and make some changes if you need to. And I think what we'll see is with those lower interest rates, and then right now we're in the mid fours ish, mid to high fours for interest rates. That's going to be quite a significant change in payment. And so pushing out your amortization, you'll have, if you had your mortgage in 2020, you've got 5 additional years that you could push back your amortization and get that payment a little bit lower. And so I think there's just going to be a lot of strategies that we have to look at to help people manage their payments. But the other thing that I wanted to mention in regards to renewals is that recently there were some legislation changes where you can actually transfer from lender to lender without having to go through the stress test. And so that's going to have that's going to be helpful in terms of shopping around, because previously we would have to qualify you at the contract rate plus 2%. Now we just have to qualify you at the contract rate. So that's going to open up some different products and some different lenders for a lot of people, which I think is really key.
And do you think that lenders will take this and use this as a competitive advantage to try and gain new customers from other lenders? Like, is it going to be like a lender battle or something?
I think it's going to be really interesting. What I've seen so far over the last year is that lenders are being really aggressive on keeping their clients. They want to keep their clients. And so what we saw a couple years ago was lenders, especially some of the big banks, were reaching out to their clients early and offering these rates to try and lock them in ahead of time, especially when rates are high. They like to lock you in, right? Because they make a little more money.
Of course.
So what I've kind of been advising my clients is, let's stay the course. Let's watch what rates do. We can get a rate hold about 120 days, 90 to 120 days, depending on the lender, in advance. So what's kind of nice about that is we can submit and then watch where rates go up until your renewal date. But I do think lenders are going to be very aggressive on retaining their clients, which is good for borrowers. It means they should be able to get a fairly competitive rate. And it might be challenging to move your mortgage and try and get a similar competitive rate, because that lender is going to try really hard to keep you. So it will be interesting to see, but I think overall it should be fairly positive for borrowers, as long as they don't fall for some of the tricks that some of the big banks will do.
And so that was my next question, is if somebody is locked in with, say, one of the 5 banks or however many big banks we have, should they be looking at other options instead of just taking what is offered to them at, say, Scotiabank, TD, whatever? Is it going to benefit them to shop around or work? Obviously, I always encourage them to work with a mortgage broker, because then they have options to choose from, obviously. But what is your obviously take on looking at other options of than just taking what you're offered by the bank?
Yeah, I would say always shop around. And that's what we do as mortgage brokers, is just look at what options are out there for you. The only time I would not necessarily recommend that is if your financial picture has really changed, because and say you couldn't qualify anymore. Because if you do transfer lenders, you're looking at a full requalification. So we're looking at your income and your credit. Whereas if you renew with your current lender, oftentimes you're not going through the full requalification process. You're just, maybe they'll do a quick credit check or something like that. So if your financial picture has really changed and you couldn't qualify for what you currently have, then of course you want to just renew with your lender. But that's not usually the case. Usually if you have the mortgage, you can requalify for it again. Usually your mortgage has gone down and traditionally your income has gone up. So usually you're A-okay to shop around. And I would always recommend it, right? Because this is the time to do it. You can maybe save yourselves a few bucks, or maybe you need a line of credit in place, a home equity line of credit, because you've got some upcoming expenses. Maybe kids are going to school or renovations or something like that. You finally want to take that vacation. So it's just a great time to, as I mentioned before, reevaluate, look at your financial goals. What can you do to structure your mortgage in such a way to help you reach that, and maybe save a few bucks on an interest rate as well?
Right. So how far in advance should somebody be? So for example, our mortgage comes due in December 2025. You had mentioned the rate lock can be between, say, 90 and 120 days. Do you still encourage people to start planning well in advance of that, to be able to start making, more educated decisions? Because, for example, if my credit was not great, just based on a debt load or whatever, and I was speaking with you, and you're encouraging to work on that credit just to help with the situation when it comes to renewal. Is the credit with your current lender, is your credit score with the current lender that you have going to have a huge impact? Because if that's the case, then obviously you need to start planning well in advance so that you can build up your credit back up, or whatever.
Yeah, great question. I usually recommend reach out to your mortgage broker 4 to 6 months in advance. Usually, usually your mortgage professional will reach out to you and say, "Hey,
They're a
your
good
renewal's
one. They
coming."
should be reaching out to you.
That's right. Usually they'll track it and reach out to you and say, "Hey, your mortgage is coming up for renewal this year, and let's hop on a call." But yeah, 4 to 6 months in advance is ideal. It, like you said, if you've got any credit issues or you need to tweak some things, it gives you some time to do that. The worst is when people come to me, 2 weeks before their renewal and say, "Hey, what can you do here?" Well, not a lot in 2 weeks. Usually it takes about at least a month, sometimes 6 weeks to do the transfer process and get a new mortgage in place. So in that situation, you'd have to renew into an open if your lender allows, and then you'd be delaying your renewal date. But so yeah, give yourself lots of time. I'm a big fan of earlier is better, because then you can look at all the pieces, make sure everything's going to be a-okay, and then you can just wait and watch rates and see what your lender is going to offer you, see if there's other competitive rates out there, or specifically if you've acquired high interest debts. Maybe you don't want to renew at all. Maybe you want to refinance and consolidate those debts into a new mortgage, kind of ease your cash flow, just put you in a better position. Again, it's a great time to really do that. So that's certainly one of the things that we review with our clients when we're on the renewal call. Ask if they've got any high interest debts they need to get rid of, and if they're tight on cash, we can help them with that.
Yeah, and that's, alleviates a lot of stress for people, especially with cash flow, being able to not have several $1,000 credit card payments every month, because of the high interest debt, right? So being able to
Absolutely.
roll that in, could be a huge, huge game changer for your financial
Huge.
picture, and smarter, obviously, because your interest rate is not 25%, right?
Exactly. And it's, once you're in that cycle of high interest debts, it's really, really hard to get out, because you're just making minimum payments at 22%,
Yeah,
which is not paying down your principal very much and very quickly. And so I know it doesn't always feel good to take a higher mortgage amount, but it makes sense to do it if you're going to cut that interest rate down by a quarter, or 3/4, and be able to actually tackle that principal and pay that
yeah,
down. It makes a lot of sense. And oftentimes what I see is, because it can free up sometimes thousands of dollars a month, certainly hundreds of dollars in cash flow, you can then take that and put it back on your mortgage by using your prepayment privileges, or you can set it
right.
aside for savings, whatever you need to do. But there's ways to tackle that debt, the higher mortgage amount that you've then incurred. There's ways to tackle that, because you have a lot more cash flow. It's just a little bit, you can live a little easier, I think, sometimes, especially if you have that high interest debt. It kind of looms over you, right? So getting it gone is just a good feeling.
Yeah, for sure. Now, another quick question about the fixed rates. So when you're in a mortgage renewal year and you're in a fixed mortgage, obviously the closer you are to your date, the less amount of penalty. Is there obviously there's no penalty at all if you're renewing at the date that you're supposed to be renewing? How does that work?
Yep. So if you renew on your renewal date, there's no penalty there. Or if you transfer on your renewal date, there are some lenders who will allow you to pay those mortgages out in the remaining month in the remaining month before your renewal date without penalty. But oftentimes there is a penalty associated. Yes, it does get smaller. And usually, I mean, with fixed rates, the penalty structure is either 3 months interest or what's called an interest rate differential. And the 3 months interest is pretty standard. Sometimes they'll just do interest per diem up until closing. It really depends on the lender that you're with. But with that interest rate differential, when we see interest rates come down, and if you have locked in at a higher interest rate, the interest rate differential is a calculation, but basically it just depends on where current interest rates are compared to what yours is. So if yours is 5 and the new mortgage and the mortgage rates are now 4%, then there's an interest rate differential of 1%. So that's going to be a pretty large penalty for you. But as you get closer to your renewal date, that penalty will get smaller. And so what we do is try to help you with that, especially outside of renewal. If you do have to break your mortgage, we'll try and help you figure out when's the best time to do it so that we can get that penalty as small as possible, because there's some things you can look at to be strategic about it. But oftentimes what we'll do is get our clients to renew into an open term. If we're changing lenders, we'll get them to renew into an open term so that if there are any delays for whatever reason, even a day, there's no penalty charged. Right. Does that answer your question? I maybe went off a little off the rails there a little.
Yeah. I think there's going to just be so many questions with people who do have mortgages renewing, and just the fact that they're not in this industry every single day and they don't know how to navigate or even what to do to navigate. Like you said, there's people that'll, call you up 2 weeks before and go, oh, I didn't realize, but I've got this in the mail and we renew in a couple of weeks. And what do we do? If your mortgage professional hasn't reached out to you and giving you a heads up on, what you need to be working on and doing, red flag, first of all, use somebody else. But yeah, you want to make sure that you're working with a mortgage professional who, like Karlee, can help you navigate and can help you put a plan together well in advance so that you have time to kind of comprehend what it is that you want to do, what is going to be best for you, and just how to navigate, because there's lots of strategies involved, even if you're renewing and, excuse me, and in a couple of weeks, maybe there's a Bank of Canada rate announcement and you are going for variable. There could even just be a strategy behind waiting even for that or something, right? Like there's so many different avenues for you to navigate that it's so good to be able to have a professional in your corner to be able to throw all these questions at, because they do this every day and they know, what the landscape looks like now and what is forecasted. Like I've said before, none of us have a crystal ball. None of us know exactly what's going to happen. But, if we follow it closely, we can help navigate through what's going on anyways.
Yeah. And just to have peace of mind too, because what we can do for our clients is just look at the renewal rates that are offered to them from their current lender and just let them know, yeah, those are great rates. Those are competitive. You'll be safe there. Or let them know, no, we can probably get that lower for you and help them out. So if you reach out to us, you don't have to work with us, right? Like we're here to kind of advise you and help you and get those. It's not even to get the lowest rate, but just to make sure that you're in the best mortgage product for you. And renewal time is a great time to do that. But if we don't have the best product for you or the best rate for you, we'll let you know. And we'll say, no, that's great. Renew there. And then at least you have peace of mind and you can renew confidently knowing that you're good.
Yeah. And I think that, I give credit to any mortgage professional that does say, you know what, I can't touch that mortgage rate, or I can't beat that, situation. You're better off, staying with X lender or whoever, because that just goes to show that you do truly care about what's best for the client. And
for sure,
I'm a huge, huge supporter of, like, you do what's best for the client. You don't do what's best for you. And anybody that I ever work with or I'm talking with on this show are all people who align with my align with me and my what's the word I'm trying to think of? What is it? Values and morals. Yeah, I knew it started with an M. I'm like, why can't I think of this word? But align with my morals and values, because it is a client focused business that I run, and we want to make sure that you're taken care of, and you're not coming back to us in a year or two and say, why didn't you tell me I could do this? Or why, because I think the situation with a lot of people who are renewing this year may have accumulated, like myself, a lot of debt over the last 5 years, where now you're looking at, okay, how can we roll that debt into this new mortgage and alleviate some cash flow pain, right? So
Absolutely.
I
Yeah.
I think I think that's going to be a huge thing this year. So I don't know if you have anything else to add, but I think that, we've covered a lot of information, and what I'll do is I'll make sure that you guys have our contact information. If you want to reach out to us, my name is Michelle Ellis. I'm with eXp Realty, and Karlee Moore is with.
I'm with George Moore Mortgage Services. So feel free to reach out. No obligation. You just give me a call or send me an email, and happy to answer any questions. Michelle and I were talking before we started the show just how important it is for us to get the information and the education out there. And so you can always feel comfortable reaching out to either of us, and we're here to just answer those questions and make mortgages. Well, I'll try to make mortgages a little more relatable, a little easier. And something you touched on earlier too, Michelle, is just you had mentioned that people don't always know about mortgages, right? And they shouldn't necessarily. Like, we have so much going on in our worlds and in our lives that why do you necessarily need to know everything about a mortgage? That's what I'm here for. And so my goal is to just sort of make it easy, take the pressure off, give you the education, allow you to make the best decision, but not have you feel stressed or unsure about the mortgage process or the mortgage in general. So, and I think you're much the same with real estate, Michelle, as you try to take it on so it's an easy process and somewhat of an enjoyable journey. I don't know how enjoyable mortgages are, but certainly buying a home is fun and exciting, right? So, and being in a better financial position is a positive. So that's what we're here for, is just try to make it as stress-free as we can.
Absolutely. And like I said, you can reach out to either of us at any time. We're very transparent. We are very honest and open. We are not out to make the next quick buck. We are here to actually help lead you to an educated decision that will, help you in your financial future. We're somebody that we are people who like to stay with you along your journey well after the transaction. For me personally, I've been in real estate for 10 years. I still have relationships with people that I sold houses to 10 years ago that are still in that house that I sold them 10 years ago. So it's not just a one and done and on to the next. For us, we want to be here for you long term, and super excited to have had you on today, Karlee. Your wealth of knowledge is amazing, and we will be on the show again, and we will talk more mortgages in the future. Appreciate everything that you bring to the table for us.
Awesome. Thanks so much for having me. Appreciate it.
Till next time, guys. We'll see you next time.